Hey folks, welcome to a product review at Finominal. Today we're going to look at T. Rowe Price's Capital Appreciation Fund, which trades on the ticker PRWCX. Now, the fund has a history of going back into the early 1990s, so we have a long track record, and it manages an astonishingly $65 billion. Now, let's investigate in terms of what makes this fund so successful, and we're going to kick off with a simple benchmarking analysis. Now, the fund itself allocates across asset classes, although the majority is towards equities. So half of the portfolio, or at least half of the portfolio, will be stocks. The remainder is primarily invested into fixed income, and their allocations are all over the place. This is US Treasuries, MBS, convertibles, investment grade bond, and it's a fund that is actively managed, so these allocations also change over time. Now, if you see the suggested benchmark from our perspective is the S&P Target Risk Growth Index, and that kind of makes sense, right? Because you have a diversified portfolio comprised of stocks and equities, and our suggested benchmark is an index that allocates to stocks and bonds. Having said that, if you look at the fund's fact sheet, it actually shows the S&P 500 as its benchmark. And so in this case, we're actually going to use this, which usually would be a little bit an unfair comparison in terms of comparing a diversified portfolio versus the S&P 500. But in this case, we can actually see that the fund has actually outperformed the S&P 500 since, well, 1993, which is impressive. Now, let's dig a little bit more into in terms of like if you can explain the outperformance. So first thing we're going to do is look at a returns-based factor exposure analysis, just to see in terms of what has been driving the risk returns of this fund. We do see here the factor betas over time. This is only the last 20 years. And we can see there's been a consistently positive exposure to the US stock market, as expected. Yeah? Half of the portfolio stocks, or more than half. The exposure to other asset classes, let's say like investment grade bonds, the US dollars, even commodities, is zero on average, but it fluctuates quite a bit. And that simply highlights the active management, right? And that allocations within fixed income, right? That they are shifted, right? Over time. We can also see that the exposure to equity factors has been mixed over time. There's no consistent exposure here. Perhaps more importantly, from a risk perspective, we can see that almost all of the return can be attributed to the stock market over time. So, bonds or equity factors or US dollar or commodities haven't really mattered. If you look at this fund from an alpha perspective, we do see that it actually does have a pretty impressive track record. So we can see there is a alpha consistency, right? In 19 out of 22 years, alpha was generated. Now that doesn't mean outperformance compared to the S&P 500, because you can see that only happened in 13 out of 30 years. But in most of the years, we can't explain the performance. And that's what alpha is. Alpha is just the unexplained return. It is also worth mentioning, right, this high tracking error compared to the S&P 500 kind of makes sense because you got fixed income in here. But if we look at overall return contribution, we do see, right, that bonds hardly mattered, equity factors hardly mattered. Most of the return can be attributed to the stock market, but there's also this, like unexplained return here, alpha, right, that has been pretty consistent and also significant over the entire track record going back to 2004. And that's of course impressive, right? So that speaks to the manager. Having said that, alpha was more plentiful historically, right? And this unfortunately is the nature of the industry, right? It has become much more competitive. So there's a lot less alpha in the most recent years. And it's kind of interesting to see how the behavior of the fund has changed if we do reduce track record to something more like the last 10 or 20 years. In this case, I'm going to switch to the asset comparer because there we can see the rolling returns. And what I'm going to do over here is simply look at the rolling returns since 2000 effectively. So let's update this. And what we see over here is that basically in the 2000s, which is basically like where the tech bubble or tech implosion occurred, there was a big discrepancy between the fund and the S&P 500, but thereafter, the rolling return has become almost identical. So that's kind of interesting to think about, right? That a lot of the value that the fund has generated happened, like in the early years, right, rather than later years, and there's not much differentiation here. Another question that we asked ourselves, right, would you be able to replicate this fund? And in this case, what I'm going to do is I'm simply going to take a portfolio that is a combination of stocks. In this case, I picked just VUG growth ETF and some bonds, US treasuries, bills. And so effectively what you can see is the performance of T. Rowe Price's capital appreciation funds from 2007 onwards, right, to today. And you can see the kind of replication that is comprised of VUG plus bill in an 80-20 ratio. And what we do observe is that for most of the period, the returns were almost identical. Actually, in the last, let's say 5 years, right, the performance of the replication was slightly higher, also more volatile, to be fair, right? But as you can see, is that there's a lot less unique things going on, right, in PRWCX, right, than historically. And of course, this replication is only going to cost you a few basis points versus 67 basis points for PRWCX. And this kind of concludes our analysis of this fund. So if you look at the entire track record, going back into the early 90s, right, you can see that this fund has actually managed to outperform the S&P 500, despite it being a diversified portfolio, which is impressive. Having said that, if you do look at the last 20 years, right, from a rolling return perspective, it looks very undifferentiated to the S&P 500. And in case you want to replicate that, right, almost an 80-20 portfolio does a job or can even give you slightly higher return. Hope that helps. Have a nice day.